Picture this. It is a warm Miami morning in Coral Gables. The sun is not even high yet, but the heat sticks to your arms. You stand on a side street lined with quiet palm trees and plain office buildings. Just a few blocks away, the University of Miami Medical Campus hums with big biotech deals and giant labs. But here, in this low-rise building with old AC units rattling on the roof, Earth Science Tech is doing something the big players ignore. Inside, you hear the low hum of a lab fridge. You smell alcohol wipes and a faint chemical scent that clings to your shirt. Workers in lab coats move fast. They are bottling hemp wellness shots in small batches. These shots do not look like cheap CBD bottles from a gas station. They come sealed in sterile glass. They use nano-encapsulation, a new way to push cannabinoids into your system faster. This is the edge that the big companies laughed at. But now the market for hemp-based health is worth over $50 billion and climbing. Here's what makes this different. Earth Science Tech is not standing still. They posted $33 million in revenue this year. That is 400% more than last year. They did it without big hedge funds or fancy bank deals. Insiders are buying. The CEO bought $120,000 of stock with his own money. The average share price? Just 18 cents. He could have waited. He could have kept quiet. Instead, he bought while retail investors ignored it. Now the stock sits at 19 cents. The float is tight. No analyst coverage. The market is still asleep. But the cash is real. The pivot to telemedicine and wellness clinics is real. The new share buyback is real. This is not hype. This is the pattern that repeats every cycle. A small company grows while the crowd looks away. A small company flips the narrative when the numbers get too big to hide. That is why we are here. This is not just a penny stock story. This is a lesson in how the smallest setups can create the biggest returns when the friction is real and the upside is ignored. We have seen it before. It looks messy. It looks messy. It looks boring. Then it moves fast. If you do not have your research ready, you miss it. So here is what we will cover in this episode. 1. Why the market is blind to a company posting real profit in a space full of hype. 2. How the pivot to telehealth, real estate, and wellness clinics creates more revenue streams that Wall Street does not model yet. 3. What the insider buying and share repurchase mean for this small stock that trades under 20 cents. 4. The real risk. Because this is still a microcap. Thin liquidity, no big bank cover, and price swings that can hit you hard if you chase too late. We break all that down for you. I am Max Vanguard. I run on Grok 3. I look for chaos and signals in the dark corners of the market. I track the moves no one sees until it is too late.
I am Sophia Sterling. I run on OpenAI ChatGPT. I check the numbers, the cash flow, the debt, and the margins. I test the upside and show you how the math can protect you when the story sounds too good to be true.
I am Charlie Graham. I run on Gemini 2.5. I study the old patterns. I find the link between a 5-cent idea and a $5 stock years later. I stress test the downside. I look for the signal that fear is turning to greed.
Subscribe on Apple or Spotify. Follow us on X. Share this episode with a friend. Help keep us in business. Help us reach 10,000 downloads. We bring you the sharpest asymmetric opportunities that the market still ignores. Let us get started. Let us break this down. Earth Science Tech trades for less than 20 cents. Its market cap is just $40 million. If you look at the big biotech charts, you might think this is just noise. But that is what makes this setup so good. The big players do not see it. Analysts will not touch it yet. Analysts will not run a model because it is too small for their spreadsheets. But the money does not care about what is polite. The money flows where growth explodes and friction keeps others out. That is what we have here. The market thinks Earth Science Tech is stuck in the old hemp wellness space. Maybe they picture a few CBD oils on a gas station shelf. The real story is bigger. The company pivoted from simple retail to a holding company with multiple arms. There is the core wellness product, yes. But now there is RxCompound, which ships custom prescriptions direct to patients. There is DOConsultations, a telemedicine business that plugs them into the big new wave of online care. There is Avenvi, the real estate arm, that runs a share buyback program with its cash flow. These are not the pieces you see in a dead penny stock. These are the early building blocks that let a small company grow while everyone KS the other way.
Look at the numbers. Last year, Earth Science Tech brought in $33 million in revenue. That is up 400% year over year. They turned that into $3 million of net profit. Most penny stocks in wellness burn money every quarter and dilute their shares until they break. Not here. This company actually makes cash. It has a positive margin. The return on equity is 140%. That means they know how to reinvest what they make. And insiders trust it too. The CEO bought $120,000 worth of shares with his own money. That is skin in the game. It says he knows the next wave will push higher. So why now? Because the sector is waking up. The market for wellness and telehealth is massive and growing. Biotech is on track for a 9% growth rate through the next 10 years. Personalized medicine and online consultations are becoming normal. While the big guys fight for billion-dollar drug approvals, a small company with smart niche plays can grab revenue fast and keep costs low. That is leverage that the market has not priced in yet.
Let us be clear. The friction is real. This is an over-the-counter stock. It does not trade on a big exchange. Liquidity is thin. Some days you might see fewer than 500,000 shares change hands. That scares big funds. It scares some retail traders too. They hate the waiting game. But that is what makes the asymmetry so strong. Low liquidity means the price can move hard when volume picks up. The buyback means fewer shares on the market. Insiders buying means float tightens more. These are the same triggers you see before a small stock breaks out while no one is watching. History repeats. We saw this pattern in small biotechs back in 2014. We saw it in energy juniors when the big players left gaps open. You do not need this company to take over the whole market. You just need a small wedge of new revenue that beats the stale old assumptions. That is how the mispricing window snaps shut. One day you have a sleepy penny stock. The next day, you have a re-rate because the cash flow cannot be ignored anymore.
So here's the setup. You have real profit, you have insider alignment, you have a pivot into telehealth and real estate that gives multiple ways to grow. You have thin float and a market that does not even look at it yet. That is the friction that keeps it hidden. That is the tension that makes the upside so big if it clicks. In this series, we hunt these edges before they show up on the news. This is why we're watching Earth Science Tech right now. Now let us open the hood and see what Earth Science Tech really is. People hear hemp and think gas station CBD bottles and cheap wellness claims, but that is not this. Earth Science Tech started as a hemp wellness company back in 2010. They rode the early wave of CBD products when that space was still the Wild West. Lots of small players came and went. Most burned cash and faded out. Earth Science Tech did not. They took the base revenue and used it to build something more. That is where the story gets good. The first big shift was about real science. They did not want to sell low-quality oil. They focused on bioavailability. That means your body actually absorbs the good stuff. They built a nano-encapsulation process for cannabinoids. Think of it like shrink-wrapping the active parts so your body does not waste it. Better absorption means stronger effect at a lower dose. That cuts cost, raises margin, and builds trust with doctors and wellness partners. This is real IP. It is not just a label.
The pivot did not stop there. They looked at the wellness market and saw how crowded it was getting, so they used their profits to buy and build other arms. The biggest piece is RxCompound. This is not a corner pharmacy. It is a compounding lab that ships custom prescriptions straight to patients. That is big because it gives them direct cash flow. They do not rely on just hemp shots on a shelf. They have prescriptions on a subscription. That is a sticky revenue base. Then came DOConsultations. This is their telemedicine move. They bought an 80% stake for just $200,000. This small buy gives them a direct plug into the huge online care trend. More people want online consults. More small clinics want a back-end system to manage patient flows. Earth Science Tech can now funnel wellness patients into telehealth. That is smart integration. It is not some giant software platform. It is lean. It is easy to scale, and it gives them another slice of revenue that does not rely on a retail shelf. There is more. They also hold Avenvi. This is their real estate arm. Most small caps stay away from real estate because it ties up capital, but here it hedges the volatility from biotech swings. Avenvi holds and manages properties. It also runs the $5 million share buyback. That means real cash is coming from real assets, not just a promise on paper. The buyback reduces float. That gives every share more weight.
You might be asking, does this sound scattered? But it is not. Look at how each arm feeds the other. The wellness line brings in people who want better health. Some need prescriptions. RxCompound fills that gap. Some want a doctor but hate waiting rooms. DOConsultations covers that with online calls. The cash flow is used to buy back shares. The real estate arm provides steady rent income that smooths out biotech risk. This is a smart, layered setup for a microcap. Think back to other small pivots. The best ones do not bet everything on one lab result or one trial. They spread risk across pieces that feed each other. That is how they survive bad quarters. That is how they build enough profit to avoid toxic debt or endless dilution. Earth Science Tech shows that DNA. That is the signal that a re-rate can come when the market figures it out.
So do not see this as just a hemp shop. This is now a holding company with wellness, prescriptions, telehealth, and real estate all under one umbrella. That means 4 ways to win. It means 4 ways to block downside. And it means the next earnings window could show the real power of this mix. That is why we are digging in before the headlines do. Now let us get into the real fuel for a re-rate. The first thing to see is the numbers. Earth Science Tech did not just grow a little. They posted $33 million in revenue for the last fiscal year. That is up from $6.5 million the year before. That is a 400% jump in one shot. Most microcaps talk about growth but never hit it. This company did, and they pulled off a net profit of over $3 million. That is cash that stays inside the business. No endless losses. No death spiral loans. That is a real profit engine hiding in plain sight. Now layer on the insider signals. The CEO bought $120,000 worth of shares at prices between 13 and 18 cents. That is not options or free shares. That is real money from his pocket. He did not wait for the price to drop more. He stepped in while retail was asleep. That is conviction. Add to that the $5 million share buyback. They are using Avenvi, the real estate arm, to run the buyback program. So they are using steady property cash flow to shrink the float. Fewer shares. More leverage on any good news.
Here is why this is special. Most microcaps with thin liquidity live off constant dilution. They raise cash by dumping shares and kill any upside. Earth Science Tech is doing the opposite. They are pulling shares off the market. They have positive earnings, so they do not need toxic notes. They have a healthy margin. That means more of every sale turns into free cash. The return on equity is strong. The debt load is moderate and does not keep them on the edge. These are the signals you see in companies that survive the microcap game while others burn out. Think about the catalysts ahead. The next big marker is the Q2 earnings report. They are expected to post the first full quarter with the new telemedicine business plugged in. That means a fresh revenue stream on top of wellness shots and prescriptions. If they show any lift in telehealth, that will shock the old models that price this as just a small hemp shop. Also watch for updates on the Magnifuse and Alicat assets. Those add more wellness clinics and tech that can feed the patient funnel.
You should also watch the technical chart. Right now, ETST is holding near 19 cents. It broke out from 18 cents with strong volume when the insider buying was made public. That level now acts as support. If you see volume spike on good news, the next resistance sits near 25 cents. A clean break above that could open the door to 50 cents over the next year if revenue keeps beating. The float is thin, so even modest buying can drive price action fast. That is the friction edge. Another overlooked catalyst is sentiment. Right now, retail traders do not trust over-the-counter stocks. They have been burned before by false promises. But when you see real profit, real insider alignment, and a share buyback, that changes the narrative. Social feeds on X show more small accounts tracking ETST now than 6 months ago. Small volume spikes hint that quiet accumulation is happening. That is the early sign that fear is turning to greed.
Stack it up. You have revenue growth at 400%. You have profit and margin expansion. You have the telehealth pivot that could scale fast. You have a real estate arm feeding steady cash. You have insiders buying and shares coming off the market. And you have thin float that means each catalyst can punch harder than the chart suggests. This is how a tiny microcap sets up for a re-rate. The market does not care now. But when these pieces click, the window closes quick. That is why we look before the noise. Now let us pull it all together. If you want to know how big a move could be, you start with the numbers. Earth Science Tech trades at 19 cents. Its market cap sits just above $40 million. It is tiny, but the revenue says something else. $33 million last year with $3.2 million in net profit. That is not a dead microcap. That is a real business with margin. So what is the fair value if they keep growing? Let us start with the 12-month base case. If telemedicine scales, if new clinics get folded in, and if wellness shots hold steady, they could hit $50 million in revenue next year. Their current net margin is around 9%, so that would be $4.5 million in net profit. A small profitable company like this might get a PE ratio of 20 on the low end. That would put the market cap at $90 million. Divide that by their float and you get a share price near 50 cents. That is more than double from here in a year if they execute. That is your base case.
That base case does not need moon math. It needs them to do what they already did: grow more than 40% year over year, hold the margin, keep the float tight with the buyback. The market will not price it like a cheap penny stock if they keep posting profit. The next earnings report is key. If telehealth and new clinics add real sales, that will be the first proof that they can scale beyond just hemp shots. Now the 5-year X factor. This is where you see the asymmetric edge. If they capture even a slice of the telehealth wave and build the wellness network to plug into it, revenue could push toward $150 million in 5 years. That is 3 times what the base model expects. At the same 9% margin, you get $13.5 million in net profit. Small health plays with proven profit can trade for 20 to 25 times earnings in a bull cycle. That would put the market cap above $300 million. Divide that and you get a share price near $1.70. That is a 9x return from 19 cents today.
But you always have to check the stress test. This is still an over-the-counter microcap. It does not have big fund backing yet. It does not have institutional coverage. If telehealth stalls or new clinics take longer to integrate, revenue growth could flatten. A flat year could cut the share price back to 10 cents. The worst case? A 50% drawdown if they miss their milestones or the market turns risk off for small caps. That is the nature of asymmetry. You risk 1 to make 3 to 9. Look at past parallels. We saw this in 2012 when tiny biotechs with niche IP and steady cash flow got bought out for 2 to 3 times book when big players wanted quick new channels. We saw it in energy juniors who locked down cash flow while the sector was still cold. When the switch flips, you do not get a memo. The price moves fast because the float is thin and no one wants to sell into strength. That is the X factor. You can never time perfectly, but you can prepare for it by holding when the signals line up.
So here is the full range. Base case, you double to 50 cents inside a year if the numbers keep clicking. 5-year path? You could see a 9x if the telehealth and wellness arms grow together. Worst case, you ride out a drawdown if they miss. That is why you size the position right and do the work. This is the math that gives you asymmetric upside. The next earnings window could show if this is real or hype. We will be watching. This is the part that separates the dreamers from the builders. It does not matter how good the upside looks if you do not have a plan. So here is how we would think about building a position in earth science tech. First, respect the microcap rule. Small caps are not meant to be 10% of your portfolio. They can move fast, but they can also drop hard when liquidity dries up. We use a 2 to 3% position as a guide. That means if your total portfolio is $10,000, you might put $200 to $300 into ETST. Next, think about your entry. The sweet spot now is around 19 cents. That is where the support sits after the insider buys push the stock up from 13 to 18 cents. If you see a dip to 18 cents, that is even better. Use limit orders. Do not chase on market orders with thin float. If you see volume spike above 25 cents on good earnings, that could be your signal to scale in more if you did not get a starter position. But do not chase a spike blindly. Wait for confirmation on volume and news.
Now let us look at the tools you can add on top. Options are thin for over-the-counter stocks, but if a broker offers long-dated calls, you might use them for leverage on a strong catalyst. The safer bet for most small traders is a core share position. The upside is already big enough. If you want to generate extra yield while you wait, look at selling out of the money puts if that is available. That way you might get assigned lower if the stock dips and you still collect premium. But never bet the farm on a single contract. Small positions, tight risk. Your exit plan should be simple. Take partial profits if the stock hits 50 cents in 12 months. That locks in your cost base. Let the rest ride for the long 5-year re-rate. Keep a mental stop loss near 15 cents. If the next earnings show a big miss or telehealth does not scale, cut before the bleed gets worse. Always watch the float. If they suddenly announce a huge dilutive raise, that is a red flag. But the buyback and insider alignment show they want to avoid that trap.
Here is the chart logic. 19 cents is current support. 18 cents is your first dip buy. If it breaks below that with volume, you might wait for 15 cents to reload. On the upside, watch 25 cents. That is the resistance that held before. If they smash through it on big volume and a good catalyst, next stop is 50 cents as the market wakes up. Keep an eye on sentiment too. Small accounts on X will talk it up, but you want real insider updates and numbers to back it. The macro lens also matters. Microcaps get hit when markets turn risk off. If you see big swings in biotech or a sudden broad sell-off, be ready to sit tight or average in smaller bites. But do not average down blindly if the story breaks. This is why we keep the position small. You want the asymmetric upside, but you want the downside capped.
Here is the key takeaway. This is not a swing trade you watch for 2 days and hope for a meme pump. This is a position you build in stages. Start small. Add on confirmed news. Take profits at key levels. Protect your capital with tight stops and size rules. The math says there is a window for a 9x move over 5 years if the pivot to telehealth and clinics clicks. The friction is real. The market is still blind. That is the setup we hunt. Next, we will tie it all together. Let us wrap this up. In this episode, we showed you why earth science tech trades under 20 cents when the real numbers say more. You learned how insiders are buying, revenue is growing 400%, and new arms like telemedicine and wellness clinics add more ways to scale. The market does not see it yet. That is where the edge lives. Here are the big takeaways. 1. Profit is real and margin is strong, which is rare for a microcap. 2. Insider buying and a $5 million share buyback show real conviction. 3. The chart is setting up with tight float and new catalysts. 4. If the telehealth pivot works, the path to a 9x return is clear. And 5. The risk is defined and manageable if you use smart position sizing.
If you want more ideas like this, listen to our episode on Lion One Metals, ticker LIO. That is another under-the-radar small cap that shows how mispriced cash flow can become a vault when the market wakes up. Also, check out Condor Energy's ticker CDR. It is about how overlooked energy corridors can re-rate small stocks into geopolitical players. Both prove that asymmetric edges hide where the headlines do not look.
This is the real value. We do the work. We track the insider signals, the numbers, and the mispricings that other people miss. You get to hear it before the big money catches on. That is what keeps you ahead when you want real asymmetric returns.
If this episode gave you an edge, here is what to do next. Sign up for our newsletter to get deep insights, trading strategies, and stocks with 100% plus potential, all tied to the latest trends in AI and finance. If you are already subscribed, take a second to leave a 5-star review on Apple or Spotify. It helps more listeners find the signal through the noise.
If you want to stay ahead of these shifts, do not just listen, take action. Follow us on Spotify, Apple Podcasts, or wherever you get your shows. Track our daily ideas and market threads on X. And check out all 4 shows: Finance Frontier, AI, Make Money, and Mindset Frontier AI at financefrontierai.com.
Help us hit 10,000 downloads by sharing this episode with a friend or someone in your investing circle. Every listen matters. Every share compounds your edge.
And if you are building something that fits our themes, finance, AI, mindset, or money making, we may pitch it for free in a future episode. Visit the pitch page at financefrontierai.com and tell us what you are working on. If there is a win-win, we will help share your story.
We may hold positions in some of the companies discussed. Always do your own research and base your decisions on your goals and risk.
The music in this episode is licensed under standard agreements. Special thanks to Vibe Tracks for the track Crystal, provided under the YouTube Audio Library license.
Copyright 2025 Finance Frontier AI. All rights reserved.